Yes, that's what I see. Let me turn off my.
Oh, welcome everyone. And can everyone hear me on Zoom? Oops, I don't have my mic on.
We can hear you.
There. Let me get it going. Oops. Okay. The testing. There we go. Okay. They say sound is good on Zoom. Sound is good in the room. Okay, great. Well, welcome everyone to this month's the April meeting of the Dallas Fort Worth Options Trading Group. And if you're new to the meeting, it looks like we've got 28 people online and we've got 8 or 10 people here, maybe stragglers coming in person. If you're new to our group, and I had posted this link on Facebook and Discord, so we may have some new people joining us. If we meet once a month, one group or the other. We have a partner group, the Mechanical Trading System group, and we just alternate months. We always meet on the second Saturday of every month at 9 a.m. Central Time. And we always do a Zoom call, so you're welcome to join by Zoom or join us in person if you live in the DFW area or want to join us. If you want to get notifications for the meeting or join our group officially, send a blank email to the email address on the screen, DFWOTG plus subscribe at groups.io. And then send an email with your name to me, Tam Chambless at gmail.com, and we'll get you approved and in that list. All that does is get you access to we'll get the notifications for the monthly meetings. We send those to both groups, and you'll have access to all the recordings and files that we have on our server on Groups.io. So past meetings, and you can go browse, and if there's something that interests you and you want to watch that recording, you can see that. Or sometimes there are handouts with that we post online. So then next is that just to be aware, this is educational, not financial advice. And any action you take on the information discussed is your responsibility. There's always the opportunity for gain and the risk of loss. So be aware of it. Then there upcoming events toward the end of April, Friday the 25th and April 26th. There's an advanced option strategies workshop provided by Schwab. I got an email for this. It's free. You just have to register. So if you're interested in joining that, write down that email address and sign up. And that usually their presentations are pretty good. I'm going to make sure this is close this time so we catch this. Then also the next meeting will be May 10th. That's the Mechanical Trading Systems Group. And Dan is running that presentation. And tell me again what that, I gave you it's with pirate trading. It's about market profile and some of the indicators like that to use. This guy he scalps futures using it, and one of our members recommended it, so we thought it'd be a good presentation. I don't remember the guy's name, Charles something, yeah. But anyway, you'll get a notification about that. And then if you know of any other events, just send me an email, or you can send an email to DFW at optionstradinggroup.io, and that will go to everyone. If something's out there that we haven't heard about, or you hear about through the grapevine. Then this last 2 weeks have been kind of tumultuous and very interesting trading in this market. And our group forecast last time was correct. We said the market would be down. I think almost everyone said it's going to be down. And sure enough, it was down. And then it's come back some since then. So as of the end of day yesterday, SPX was at 53.6322. So now the big question is, where does the group think the market is going from here? We'll just do a group consensus. Raise your hand or put in chat if you think the market is going up. And anybody raising their hand? No. And raise your hand if you think it's going down from here. So we've got a lot of downs, and we'll see on the chat what the down from here. Yeah.
Comment. I think Trump is going to hear that there has been a lot of destruction of wealth
Yeah.
everywhere, including Europe. Concept destruction of wealth. And people like to watch their pocketbook.
Yeah.
And he could get a wake-up call saying, I don't think I should be continuing to be an asshole.
I don't know that that makes a difference to him. So, there's a comment here that Trump may realize how much wealth destruction he's caused and that it may change his ways, and I don't think it makes a difference. But the meeting in June is going to
Well, he
be,
distracted, what, 6 trillion to get 2 billion a day. So
yeah,
his math is definitely off.
something's off. That's right. So in June, we have a guy, Ed Kurtz, who's going to make a presentation to our group. He has been a bond trader. He's very informed on the interest bearing instruments market. And I was asking him this week, because I'd heard that Trump changed his mind on tariffs based on what started happening in the bond market. And he kind of confirmed that in our Discord group, that it was starting, it could severely impact the bond market. And so June's meeting, I think, will be very interesting. It's not necessarily options related, but I think it will shed some light on what's going on. Ed can Ed can talk about how you can stabilize your portfolio with some interest-bearing instruments and what he recommends, or what some options are. I'll say that, not necessarily what he recommends, but so that June should be a good meeting.
Story is we're now looking at earnings.
Yeah.
And everybody knows that. But if there's any forward guidance, it could be brutal.
Yeah.
And that's where you got to be careful.
There was a comment that earnings season is here and forward guidance could be interesting. So we'll see how that impacts the market. So welcome to anybody who's shown up. There's a badge and a donation box over there on the right. And I have stickers now for our group if you want a sticker for there's small stickers and large stickers. So welcome to any new people that we have. And first timer, all right. Any other first timers here? First timer, yeah. Okay, so our presentation today is by myself, Tammy Chambless, talking about MEIC, the multiple entry iron condors, and make sure that's what everything copacetic on the Zoom front. So I'm going to talk about the basics of iron condors for those of you who haven't traded it. And we do have some members here who haven't and are new to this strategy. A lot of members have learned about this through Dan. Dan made a presentation almost a couple of years ago now on MEIC, but we've never made a presentation to this group. So this kind of covers that base, and to talk about the multiple entry iron condors. Again, the material is for educational purposes. Your trading decisions are your responsibility. Got to have that in there. So the basic rules for the MEIC, or I'll sometimes call it MEIC, MEIC, is you enter an iron condor, and I leg into an iron condor, entering the put credit spread and a call credit spread. And you do that on a regular interval throughout the day. You use 0 DTE, 0 days to expiration options, and most of us use SPX. And the reason is that even though SPX is a large product versus something like SPY doesn't expire at the end of the day, even if you're using options that supposedly expire that day. It expires 15 minutes after the trading day. So if you traded SPY with this, you'd have to exit your trades at the end of the day. And you could do that, you just incur extra costs. But most of us traded on SPX, which has the tax advantages of trading index products, and it's a very liquid instrument, and you can make some. It's available to everybody, and it's got some great advantages and just a lot of liquidity. So I enter 4 to 6 trades a day at different times, and we'll talk about entry times. The credit targets, I target between 125 and 175. I've heard of people targeting less than $1, like 90 cents, and getting further out of the money. And I've heard of people targeting more than $2. So you can, the nice thing about this system, it's fairly robust in that you don't have to follow these rules exactly, but I would recommend, if you don't follow these rules, backtest your rules, and because the results can vary. As you vary these variables, results can vary. So make sure you're getting what you want if you do vary these rules. Spread widths, you can trade generally from 25 wide to 100 wide, but be aware of the impact on your buying power. And you could go narrower too if you need to. But stop multiples, most of us use a 1x net loss, a stop set up to achieve a 1x net loss, which is 2 times the initial credit we got on the trade. And that's, you set that on each side and you manage each side separately. So I've heard of people trading with other stop multiples. And again, if you do, and I'll talk about that further in my presentation. If you do, there's some other factors you need to consider. And then because this involves a lot of essentially day trades that are put on one day and taken off that same day or expire that day, the pattern day trading rules are going to apply. If you have an account less than $30,000 or less than $25,000 in the US, they will not allow you to place more than 3 day trades in a 5 business day period. So that is a limiting factor. I just wouldn't trade this in an account smaller than 25,000. And I recommend 30,000 just to give yourself a little buffer there. Also, I wanted to say that feel free to interrupt me with any questions. Just raise your hand. There are mics at all the desks, and on Zoom, you can put your questions in chat. We've got Dan here is monitoring questions for me, and he can raise his hand if there's a question that comes up online. So those are the basic rules. And here is a risk graph showing the iron condor with the put spread on one side and the call spread on the other side. And it's a nice big mouse. And I'm showing this one at 25 wide. So you're full, and then the credit on each side is between 125 and 175. I'm showing 150 on this example. And then being 25 wide, your max loss would be 2,500, the 25 wide times 100 less the initial credit. I just usually look at it as the width of the spread, just as a round number. And I set a stop to equal the credit I received. So that my loss is equal to the credit I received. So that's you set the stop for 2 times the initial credit, and you'll get out for a 1x net loss. And so your risk in the trade, I usually call that your risk in the trade is based on your stop. Now, there is a max risk to the trade of the buying power that you're using. That is truly your actual true risk. But most of the time, you're gonna your risk is just gonna be the stop plus some slippage that you may incur. So I recommend never risking more than 50% of your total buying power. That way, if you did take a max loss, you still have money to trade with the next day. So just never risk more than 50% of your buying power. I think that's kind of a common rule around the options industry. I mean, I first heard that from Tasty Trade, and I thought it was a good rule. I also add the rule for this strategy of never risking more than 2% of your account each trading day. So that would be your total daily risk. If you stopped out on every trade that day, which can happen, the most you could lose is 2% of your account. It's not a huge hit. It still hurts, but it's not a devastating loss versus risking more. Now, for smaller accounts, you may need to increase that to 4% just because it's hard to keep it to 2%. But I'll show you ways to reduce the risk if you need to, based on number of contracts you trade or number of entries you make. And so let's see. Then I have developed this, what I call a tranche calculator, and I'll put this up on Groups.io for members to download. And it's a way to calculate both your buying power, the risk in buying power, how much buying power you're using, and a way to calculate based on the number of tranches you plan to enter, number of entries you make, number of contracts you're trading, and the width of spread, and the credit you're getting, what your total risk is for the day. So I'm gonna, versus just showing it, I'm gonna go to Excel here, if it will call it up. There, it's calling it up. Okay. So, and then we can move this out of the way a little bit. So you can, let's edit this so we can 50,000, just edit this on the fly. We don't want to risk more than 50%. So that means the max target for our buying power is 25,000. We plan to do 6 entries, one contract, and we'll use 25 wide spreads. So doing that, the buying power, we're only using 15,000 of buying power. So we're using 60% of our target buying power of 25,000. So that I do a little analysis there, and I tell you, yes, that's okay. So that falls within your criteria. Let's say you bump that up to, let's say 50 contracts, then it's going to tell you, no, reduce the number of contracts or tranches. So it kind of changes that on the fly for you. Whoops. It's interesting. Control Z?
Yeah.
What is it, undo? Okay, yeah, something's going on here. Undo, how about I just hit undo there? Okay, so 50, put that back to 1, okay. Then the other factor is based on the number of entries and the width of the spread, the average credit you're getting. And so with a 50,000 account, 6 entries and 1 contract, 25 wide, you're actually risking, if every tranche you entered on that average premium lost, you would lose $1,800, and that's 3.6% of your account. So I don't say don't trade that because it's a personal decision. But I note that, you need to check that if that loss is acceptable to you. So if you wanted to trade, like get that down to 2%, then what I would do is, you could you could change the number of contracts you're trading, and then you can change the credit target. For some reason, 5. So, and then you can get that down to 2% of your account. So that would be your max loss. So interestingly enough, when you're using a 1x stop, your max gain that day is basically equal to your max loss that day. So you can think of it like that too. But this gives you a way to measure your risk each day, and you'll get used to kind of doing that math in your head. But it helps to have that tranche calculator as a guide. Question? Yeah. If you lose on both sides, that would be what we call a double stop. That would just be one loss. If you lost on both sides on all of your trades, that's that max loss. So that 150, because you're getting 150 if you get 150 on one side, 150 on the other side, and you lose on one side, you're at break even on that trade. If you lose on both sides, it's what we call a double stop. And if you have double stops on all your trades that day, that is a max loss. So, yeah. Yes.
So how does this work over the last 3-4 weeks with the volatility and with the movement of the SPX?
Interestingly enough, it has worked fairly well. I personally didn't trade this week. I traded last Thursday and Friday when some of the big movement was going on. I did have basically break even, a small loss on Thursday and a larger loss on Friday, but it wasn't a full a total loss on all trades. Dan has been trading this week and done okay. It's the interesting thing about
So you've received the credit.
Yes. And the interesting thing about this trade is that with volatility increasing, you're trading much further out of the money with these trades, and you can, if you choose, to collect much higher credits. So I was looking at it this week and entering paper trades just to see what would happen, but I was amazed. You could enter trades normally in a normal market, like 2 weeks ago, I'd enter and I might be 20 points away from the money with my short strikes. And this week I'm like 150 points away from the money. So I'm much further out. So it actually, it actually kind of all evens out. And I've got a slide I'll show you later that people ask me all the time, would you not trade in higher volatility markets, or would you only trade in low volatility markets because it's an iron condor? And I say, no, it works in all markets.
Yeah, in fact, not only are you a lot farther away from the money, but the amount of movement you have to stop out is much wider also, like maybe 50 or 75 points wide or 100 points wide before you get a stop out. So it evens out. Yeah,
I was setting up some trades so that I was collecting 150 because that's kind of my go-to target. And it was taking an 80-point move before I got stopped out. Whereas normally it's like a 10 or 15-point move. So it's all proportional. So when volatility expands, these trades kind of expand, and it just in relation to that.
But
so
we've had some huge SPX moves.
We have, we have. By the fact that you're entering multiple trades at multiple times, it could affect, depending on when your entries are, if you enter, say, 3 trades in the morning and 3 trades in the afternoon, and it goes crazy in the morning and then kind of settles down in the afternoon, your 3 morning trades may get double stopped, but all your afternoon trades could be fine and you're at break even. So it all kind of evens out. Yes, there is risk, and yes, you can take losses, but that can happen any day, not just these high volatility days.
You have an option, just to, you don't feel comfortable having day 2 day.
Yeah,
I mean,
yeah, you could,
250 points, 275 points, even 300 points.
yes, you can
Just on
enter,
a 2 day,
yeah,
just a
yeah.
5 wide.
Yep,
I'm getting $1.50 credit, $1.40 credit.
yep. So people are
there
talking
different
about,
ways, you know, if you don't feel comfortable with that.
exactly,
different
yeah.
ways to do it if you.
There were other hands. Anybody else? There's, okay. So some of the variables, let's see, some of the variables in MEIC are, entry times can vary. Like I've been doing, for a while, I've been doing back testing at the end of every month to look back at the last 6 months. And I use that, what the best times for the last 6 months are for the next month. So, Dan started out, he did back testing originally on this going back several years, like till 2016, and selected these times 11:30, 12, 12:31, 1:34, and 1:45. Those are all central time. Generally, for those of you on Zoom, most of the time frames we're going to talk about are central time because that's where everybody in the group is. But he's consistently used those. And I'll show you some stats. The longer time period you test, the more stable the performance of those times. So if you test what happened last week and expect to use that this week, you're going to get blown out of the water because it's not a very long time frame. But the longer, I've found that back testing from 6 months to a year is probably the minimum time frame you should test. And even go back longer than that. It takes longer unless you have a new fast computer like Dan. But doing some back testing is good for checking out what times work best. I post my monthly back testing on Discord and Facebook on the Quantum Options Facebook and Discord group. And I think a lot of you all probably heard about this meeting from that if you're on Zoom. So you can go there in the back testing, and at the end of every month I post it. Yes, Alan.
Hey, Tammy. What is there a reset in how the times go? Like, this this down move. Do you think that can reset some of the times? Market conditions change.
Yeah, that's true. It could. We'll just have to see. I mean, we went through this with COVID too, and we're able to test what happened on COVID with MEIC. But not many of us were trading MEIC then, but that actually performed very well during the COVID because of the increased volatility increases the prices. But I've also noticed that on the way, as volatility is reducing, those are some of the best trading days because that volatility is working in your favor, both intraday and in the bigger picture of reducing volatility. So yes, it could affect it, and I don't know how, so we'll just have to test this period and see.
And as far as times, who knows, right?
Yeah, that's right. Your guess is best as mine. With the market being so volatile, I think it tends to make sense to limit that time exposure rather than increase the time exposure. But I've also noticed morning entries have a higher volatility, and you can be further out of the money on the morning entries. That's in a normal market. Now I haven't looked at that detail in this market on that, but there's advantages and disadvantages to all of it. You can be further out of the money, collect more credit, but you're subjecting yourself to a longer period of time where the market could go up or down, 300 points or so in that time frame, and that is bound to stop you out. So possibly. So I recommend doing back testing to determine the best entry times. And Dale, yes.
Found any indicators, technical at all, that correlates at all with any performance?
I talk about that later in my presentation, and I'll show you, no, I have not found any indicators. People ask me all the time if trading in certain VIX markets or using some indicator. And I think it doesn't work because it's all hindsight. Nothing is going to predict what's going to happen today or tomorrow. So I haven't found any so far. People feel free to look. I just haven't found any that seem to work consistently. So I would recommend doing back testing to determine the best entry times based on your parameters, because changing the parameters, changing your credit target could make certain times work better than other times, or changing the width of your spread could change entry times. It's all like this web, and you pull on one side of the web and you're shaking the other side. So it's all interdependent. So you could determine best entry times and change every month like I do. You can determine the best entry times for every month and do a long-term test like Dan does. That both of those will work. And Dan and I really, I kind of keep an eye on how he's doing. I'm sure he keeps an eye on how I'm doing. And it's amazing how often we perform similarly. So they can both work. So
You take $1 on each side, then your risk goes down,
mhm.
and you don't get stopped out as
Yeah.
much. And I have the question again.
I have found there's kind of a balance. The question was, if you, and is there a mic up here? Maybe not, but just for Peter. Push the button, but he's asking if you go for a credit of $1, you're further out of the money. Does that mean you're less risk of stopping out? I've actually found there's a sweet spot that on the really low credits, it just takes a little move to get you stopped out. $2 move versus if you go for a $2 credit, it takes a $4 move the option has to increase $4 to get you stopped out. So, and it's all, I think going further out doesn't necessarily protect you more. So that just in my observation. Yeah. I tend to get stopped out when, like, I will sometimes take less credit toward the end of the day as premiums are winding down in a more normal market. These days, it's kind of like maybe the rules changed starting this last week, and we need to look at it. So I will say in a normal market, I tend to notice that the trades that I put on for less credit would get stopped out faster than those that I got more credit for. And my theory is that it just takes a bigger move to stop out a larger credit. Of course, your drawdowns are larger too. So consider that if you're trading the larger credits. So I would, in doing back testing to determine the best entry times, I would recommend using a minimum of 6 months to a year entry times. I've heard of people doing, a 1 week back test and using those times for next week, and that seems to work the worst. And so I did a back test on my back test to figure out what is the best time frame to look back. And I found that 6 months to 1 year seemed to, nothing's going to predict the future, but it seemed to give me more consistent results on using that look back period for the performance of the next month. So I would say a minimum of 6 months to 1 year, and what Dan is doing going back, 5 years, even better. And just know that any one period within there, it's going to deviate from that. But overall, you're going to get an overall average good performance. Dale.
Are you aware of anyone who buys a basket of wings and then just trades the short strikes around it?
No, no.
So, there's, you do a deal, you put a trade on at 10 o'clock in the morning. At 12 o'clock, Trump comes out and says, we're doing away with tariffs, or we're doing them to not 90 days, we're doing them to a year. So then you put a trade on in the afternoon, 1 o'clock. Holy cow. I mean, how does that trade work out?
It, you have, when you're entering multiple times, any one trade can go bad and the day still turn out okay. It's not, your trade isn't dependent on one trade. Your day, performance for the day isn't dependent on one trade. But yeah, that one trade could be blown out, or any trade you put on before that could be blown out. So,
Well, one side of it's gonna be blown out.
yeah, and then you're at break even.
Then you're at break even. One side blows out, you're at break even. Yeah. Like it shoots up.
Yeah.
Falls, went away, but you still got your foot.
Yeah.
Yeah.
You just are at break even. So what is more dangerous is it goes up and then it goes up 300 points and then it comes down 600 points. Then you're stopped out on both sides.
And that's why your recommendation, Tammy, is only doing 2%.
Yeah,
Yes,
yeah,
makes a big difference, because getting double stopped on all positions,
Every trade.
all sides. Yeah, my experience is that happens about once every 9 to 12 months. We'll end up,
Yeah.
So
Yeah, that's-
you'll go a whole year without being
Yeah.
double stopped.
I have a chart when we get to
you're
it.
really, what you're doing here is you're playing the statistics.
Exactly.
A large number of trades, what's the winning percentage on that large number of trades, and how much you're risking, and you're just playing statistics.
Yeah,
Is what you're doing here.
exactly.
Uh,
So yeah, if you lose 2% that day, no big deal. Yeah, it's bad to have a loss, but you're still alive to trade the next day. And, in our Discord community, we're always keeping an eye out for when is Trump speaking, and let's hold off trading until after he speaks. Or like Powell is starting to speak more lately. I noticed this coming Friday he's speaking, and we may hold off, although he's tending to have less impact on the market because we kind of know interest rates are going to be flat for a while. He's done a good job of informing the market about that. So let me move on here. The credit targets can vary. So like we've been talking about, you can do a high or low credit target. The spread widths can vary. Some use a narrow spread because it uses less buying power. Some use a narrow spread just for other reasons. That's just how they like to trade, and they control their risks that way. I personally have moved to trading wider spreads, and it's because I'm now putting the stop on the short leg only rather than a stop on the spread. And so I do a wide spread so that I can basically ignore that long leg and focus on the short, the premium I got for the short leg. And I'll go into all that. We're only on slide 6 and I got about 70 slides here. So let's move along. And I cover a lot of this in the presentation. So I don't mind your questions because we will get there. We'll talk about it. And then the stop multiples can vary. So, 1x, 1.5x, 2x, really whatever you want. And you can do less than 1x. That's what I've been doing, is just slightly less than 1x. So let me move. I'm going to talk just on one slide about METF. There's another trade, multiple entry trend following, that you'll hear us talking about that's very similar to MEIC, but it's trend following. So rather than enter both sides of an iron condor, you're entering one side depending on which way the market is moving at the moment of entry. And so it looks at the EMA, and you can use 25, really whatever EMA you want to use. And depending on which way the market's going, you enter puts if the short-term EMA is above the longer-term EMA, and calls vice versa for calls if the long-term is above the shorter-term EMA. And what we found, Dan's experience, I haven't traded as consistently as Dan has. He's been, I think since like last July or so, you've been trading them both. And what that does is help even out your profit, the P&L curve. Yeah.
Lower drawdowns, but-
Yeah, lower drawdowns overall. So this can be a good addition to MEIC. And days like yesterday, man, this is a great strategy for that. So yesterday probably would have been a break-even day for MEIC. Yesterday was a trending day. You know, the market was just going pretty much up all day from the entry. And MEIC will stop out on one side on trending days and you'll end up at break-even. But METF, it will win every trade if it's a trending market. So that way, you know, you may have break-even day on MEIC, but you win with METF. So it can help balance out the P&L. So now I'll talk in more detail about entry times and kind of how to backtest those. I'm going to talk about each of these variables in detail. And when I wrote this slide, I was thinking, man, I could do a whole one presentation on each of these topics. There, you know, just go in that in depth. So here I'm gonna show you some back testing, and this is using BYOB. This is using the 6-month look back period and 6 afternoon entries. These use the times that Dan was using. It's 12. They show up here as Eastern time, 12:30 Eastern, 1:30, 2:30, and 2:45 Eastern time. So I'm going to zoom in on this just so you can see the results. So this is over the last 6 months, 6 entries. And the results of that are, you know, for the last 6 months, a CAR of 15.67, drawdown of 18.86, which isn't great, and a CAR of 0.83. And this is just MEIC, not adding METF with it. And then I'm going to look at the 3 morning and 3 afternoon entries. And this is through 3/28, which is when I started writing this presentation. It may look different. We'll have to look at this today and see how these differ. But looking at 3 morning entries and 3 afternoon entries over the last 6 months, the CAR is up to 52.8. The drawdown is 14.5, which is less than, I think it was 18% drawdown. So my CalMAR is 3.57. So it's performed better over the shorter period of time. Then a 5-year look back period, and I'll zoom in on the next slide, uses the same similar parameters. The 5-year look back period, you get a CAR of 145, drawdown of 27.19, a CalMAR of 5.33. So that's the 6 afternoon entries. And then I'm going to just jump to the 3 morning and 3 afternoon entries performed worse over the longer period of time. Dan's strategy of afternoon entries, if you look at the longer range, perform better. So this is 127.85 CAR, a 20% drawdown, and the CalMAR of 6.28. I'm going to flip back to that prior slide just so you can see it. So the CalMAR, nope, sorry, that was the wrong one there. 5.3 for the CalMAR for the 6 afternoon entries, and 6.29 just because of the lower drawdown on the 3 morning and 3 afternoon. But the longer time period, the more they all start averaging out. So I would say, you know, if you're chasing time periods, just don't. It's better to choose a time period and stick with that than trying to, you know, if you're chasing like, well, this worked yesterday, I'll trade it today, and then you bomb out today. So this just shows how variable it is, and this is trading off of, you know, my set of variables that I used. And then we'll look at how credit targets can vary. You know, do back testing on your credit target to find out what works best for you with your account size, with your, you know, the amount you want to risk. can all influence that back test. So, in different credit markets, I think I already mentioned this, in lower volatility markets, your credit target can be lower. It may only be 10 to 20 points out of the money, and you're getting your $1.50 at that point. In higher volatility markets, you could be 50 to 100 points out of the market. And it's all just based on the risk and kind of the delta of that risk, depending on how close or how far you are from the money. Yes, Dan, question.
Online about whether you take profit targets.
The question about profit targets, I don't, because I have never found a back test that shows it to have any advantage. Very often in this trade, you'll be positive all day, and all of a sudden at the end of the day, you have a bunch of stops hit. Yes, that is frustrating. But if you if you see that coming, it's okay to close early. If you see, hey, Powell is speaking and it could change, and I've got a profit right now, I'm just going to take my profit and sit out the afternoon. That's okay. But on a consistent basis, if you test like taking profits at 80% or taking profits at 2 o'clock every day, depending on whatever you have, it's closing early, what happens is it completely changes your risk to reward ratio, and it becomes an unprofitable strategy at that point if you do that consistently over time. Now, any one instance, yes, you could end up better off by closing early, but if you do it over the long haul, I found it doesn't work as well. Yes, Peter.
Okay, so this is adjunct to this thing at risk. There is a rumor running around that Trump is going to try to fire Powell. And,
Yeah.
and this concept of this announcement could be happening in the next week or two. That's a hell of a risk.
Yes.
So
You can choose not to trade. Like, yeah, you can choose not to trade.
No, I'm just pointing this out.
Yeah, good to know. Yeah. I've heard it, I've heard that, but not anything reliable, and I haven't heard it lately, but yeah. Dale.
And actually, can I have the mic?
Dale raised his hand, then I'll go to Bill.
Have you ever had it run through a stop and not? Have you ever had it run through a stop and the stop not execute?
Not a market stop. I have heard that happening, but people take it up with their broker and get it resolved somehow. But a market stop is generally always supposed to execute. Now, in some of my older videos, I used to recommend stop limit orders back when SPX could have huge spikes on any strike. Any random day, you'd all of a sudden get a 10-point strike in a spike in an option strike. That's why I used limit orders, stop limit orders when that was going on. But as of August 2023, CBOE put in place the drill through protection, and that cut out 99.9% of those spikes. And not completely eliminated them, but the majority, enough so that at that point I switched to just using market orders, and I've never had a stop blown through and not fill. Now, with market orders, you always risk getting filled at a price you don't like, but I'd rather that than a stop not fill at all. So, yes. Oh, Bill, sorry.
So one advantage of using Dan's tranches, which starts at 11:30 in the morning, is you have all the way from the opening of the market until 11:30 to watch the market.
Yeah, to see what's going on.
If the market is going absolutely insane, why would I want to go in?
Yeah, exactly. Yeah. Or if you know Powell is going to speak, or you know some like financial juices started putting on when Trump is speaking, or when there's known when he makes an announcement he's going to speak. He doesn't often speak at that time. He'll sometimes be financial juice. Yeah, we use that on our Discord. It's just a running news service, and they will post Trump's going to speak at 3:30 or whatever. So we kind of keep our eye on that for things to watch out for. So anyway, to talk about credit targets, or go back to credit targets, somebody asked, are there any indicators? This is my live trading results shown in orange, or the average premium I was getting on various trades, shown in orange, and the VIX level shown in blue. So you can see the price of the average, if you can read it, the midline right here is 150. So these down here are 125 or less, and these up here are $2 premium. So when VIX was down around 12, 13, 14, you know, I was getting lower premiums. And that's just to be further away from the money. Like if you were going for $2 premiums, then you'd be right at the money in those low volatility times. Now, in certain spikes, like here, it spiked up to 20, spiked up to 30, and this ends actually April 4th is the last day, so it started to spike up to 30. But this doesn't include this week it spiked up, it hit 50, went up a little higher than that, and I think now it's down to 40. This doesn't include that, but I wasn't trading this week, so medical and personal reasons. But this kind of shows you you can get generally in higher volatility times, you know, or as the average volatility goes up, the average premium tends to go up and you're further away from the money. I trade both manually and automated, and I use the manual trading to inform my automated trading about where should I be set? Where am I getting fills? How far away from the money am I with manual trading? And then I can adjust my automated trading to match that. Alan.
Your premium, is that just on the short or is that the spread?
That would be that's on the spread. Yeah, so I always aim for about 150 on the spread in manual trading. Yeah. So that's using 150 and how it varies. Now, you know, and when volatility is spiking up and down, you know, you can get some high premium, but you know, it can drop pretty quickly when volatility bumps back down. But lately we'll see. I mean, we could be getting higher premium now with the VIX up in the 40s, and it may be beneficial to trade that. I don't know. I'd have to back test it to see. So, and another trade is the win rate based on VIX levels. So here's 100% win rate. So there are a few where I won on all trades that day, 80% win rate. So that's, you know, what, 5 out of 6 trades roughly. 60% win rate, 50 in there, 40 down to 0. So there are a few days where I lost on all trades. This is over since January 1st, 2024. So this is a year and 4 months. So that shows you how many days in that time I lost on every single, I had a full 2% loss if I was full risk loss on those days. But most days, it really doesn't matter what VIX is doing. I'm making money, you know, in high VIX levels, and I'm losing money in lower VIX levels. It does look like it tends to, I tend to have the full drawdowns on these peaks, but it really just varies. So I'd say there's almost no correlation between what VIX level is and the performance of MEIC. So I just keep plugging away. Keep it away. So the other variable is spread widths. So I look at spread widths here, and whether to use narrower spread widths or wider spread widths. I'd say if buying power is your limiting factor, use a narrow spread width. You know, if you have a smaller account, 50,000 plus or minus, you know, the buying power is going to be your limiting factor, and you may need to use a narrow spread. But if you have plenty of buying power and your limiting factor is the risk per day, that 2%, then you can widen the spread out, and you're not risking anymore on your daily risk, you are ultimately using more buying power, but your daily risk, you're keeping that the same at the 2% maximum factor. Now, interestingly enough, a narrower spread width will be closer to the money than a wider spread width for the same credit target. If you adjust your credit targets, you can put the spread wherever you want. But I'll show you how you can select strikes for the same credit target, and a narrow spread will be closer to the money because that long costs more than a wider spread, which the long costs less. So a wider spread will get you further out of the money in a high volatility environment. And then in a low volatility environment, there's less difference between a narrow spread and a wider spread in where they are in relationship to the money. So here's a couple of examples. In a high volatility market, this was March 1st, 13th. So I call this high. 24, it's not as high as this week, but it shows you what can happen. Like a narrower spread to get with the target credit of 160, to get that 160 credit and use a 25 wide spread, at the money is 53.35. So I'm 25 points out of the money, or sorry, no, 65 out of the money. Yeah, on this. Thank you. My math when I'm giving a talk is terrible. Okay, 65 points out of the money for the short leg, and that's at delta 11. Now, I don't usually look at delta, but I did here just to see. And then I chose the 25 wide strike gets me 125 for the long. So that's $1.60 total credit. Now, to get $1.60 total credit with a wider spread, I could go 10 points further out of the money and go wider. And I just chose to go for the same credit just to show that I could have gone for, a 50 wide or more, but it would have been less credit, or more credit, sorry. So 250 on the short leg and 45 on the 205, sorry, on the short leg and 45 on the long leg for 160 credit. And the delta on that short leg is 8. So you're further out of the money. So, you tend to be safer. You've got the same credit, so your stop's going to get you out at the same point if your stop is based on the spread. So just something interesting to note. Now, in a low volatility environment, it kind of, you can end up with the same widths and the same credit. So a 15 wide got us $1.60, and that was using the 190. So we're only 15 points out of the money there for a 190 credit on the short, and we're at delta 21. And we're going 15 wide to get us the $1.60 credit. So if you go further out of the money, in lower volatility markets, the price tends to jump a lot from strike to strike. It gets harder to get that credit target. But you can use $1 credit on the short, and then your choice of credits on the long, whether you want to go 20 wide or 40 wide, it really doesn't make much difference. The 20 wide is, 10 cents for the long and 90 cents collected on that premium. And the 40 wide is, it's just 5 cents less on the long cost. So your credit is 95 cents. So it really makes less difference in a lower volatility market. But let's see how it backtests. Here's 25 to 25, 30, and 35 wide, and I'm going to zoom in a little bit. So these are the parameters I was using, 180 target premium, and I found using that tends to get me an average of about 150 credit target, and then buying power, and I'm just throwing some things in there to test it. Yes.
People are asking if they can unmute their mic to ask questions on the Zoom.
Yeah, I'll just stop now and ask questions.
Well,
Yeah.
they were asking, both typing it into chat or unmute their mic on Zoom. To ask questions.
Sure. Sure.
There's a question.
Yeah.
Tracy was asking that.
Okay. Yeah. So let's see, that was just zooming in, so I'll show you the parameters I'm using. So with 25 wide spreads, the car, and this is over, let's see what period, this is over a 4-year period that I was back testing this. Car is 166, and I think for all of these, I use the afternoon entries, just so you know. So 25 wide spread, 166 car. The drawdown is higher, interestingly enough, 26.12, a Calmar of 6.28. Now with and then here's a performance over time of a narrower spread. It starts with 2 to 4 contracts. Now with narrow spreads, you can trade twice as many spreads as you can with a wider spread using the same amount of buying power. So that's the advantage of narrower spreads. But this starts with 2 to 4 contracts in the early years. And by the time you're in 2025, it ends with over 200 contracts per trade. I don't think that's realistic to trade. So I don't know if you could get in and out of a trade very easily with 200 contracts. So there's probably you might want to set a maximum number of contracts to trade, like probably 50 contracts you could get in and out. No, this is back testing. Yeah, it looks like that though. No, I didn't go up to 6 million, starting with 289,000, go up to 6 million. But that's the advantage. You can trade many more contracts, and that's why that drawdown is higher. So let's look at 50 wide. Now, I did bump up the starting balance because usually going 50 wide, you're going to have a larger account, and you take advantage of that buying power by using the 50 wide. And I'll show you how that has some advantages. You know, the overall performance, most of the other parameters are the same on this, but the results, car is 78. I'd still be happy with the 78 rate of annual return. And, but the drawdown is much less than 9.85. So the Calmar is actually higher for the 50 wide than it is for the 20 wide. And, so it's, realize the impact on trading. You could trade less contracts. Now, I did the risk graph or the graph too. This also starts with 2 to 4 contracts. It ends with 40 to 50 contracts per trade. And, instead of going from 200,000 balance of your account to 6 million, it goes from 200,000 to almost 3 million. So, less overall return, but is trading 200 contracts realistic with the 25Y? Let me go to Fernando first.
I know you mentioned that doing 200 contracts is very unrealistic, but in your experience, have you had issues with, let's say, 20 contracts? Or is there a number that you will say, yeah, I will stay under 20 or 50 contracts?
I just personal experience. I have back several years ago when I was trading just one entry, I was kind of going all in on that one entry rather than spreading those contracts over a number of entries. I got up to trading, I think the highest number I ever traded was 90 contracts in one entry, and it got in and out fine. So I don't know where that upper limit is, but on average at the time I was trading about 50 contracts, no problem. At 50 contracts. I was going to ask Mark, do you know if there's a
best rule of thumb is if rather than going bigger number of contracts, is widen your spread.
Yeah.
There are a lot of ways, or move your, instead of trying to get $1.50 premium, try to get $4.
Yeah.
Get closer to the money, widen the spread.
Yeah.
I mean, you can trade. These things are very listed. You can trade hundreds of them.
Yeah.
But it's probably more efficient use of your funds if you have the capital to do fewer contracts and widen the spread. That's kind of a standard rule on all options.
Yeah.
Widen the wings rather than double the size, then you get bigger.
Well, I want to paraphrase that because they're not.
Oh, they're not on mics. Okay. The question was, is there a limit to the number of contracts you can trade? And I shared my experience, which you probably heard. And then we asked Mark Hobbs here what his experience was. And he said, usually if you've got a larger account, you're going to want to do things like widen your spread, like we're talking about here, or use a higher premium credit. Do some things so you keep the number of contracts down so you don't end up trading 200 contracts at a time. I would think, you probably could get into the trade and then you might have some higher slippage as you get out of the trade, just as it's trying to fill. It may take some time to fill that. So I would be interested to talk to some people who run hedge funds on SPX and see, like Mark Anderson, see what he runs into on entering trades. Excuse me. I'm gonna lose my voice here. Okay, so we've talked about the spread width. Let's talk about the stop multiples. How they can vary. And so I'm gonna share with you something I use often that's kind of correlated to the back test, but it's much easier than going through a back test. Is I use this expectancy ratio to determine the impact of stop multiples. And back a few minutes ago, I mentioned it changes the ratio between the wins and the losses when you trade higher stop multiples, or if you take profit targets. This is a model that you can very quickly see how that can impact it. So the expectancy ratio is taking your average gain or your average win times the win rate and divide that by the average loss times the loss rate. And so in this case, if we have $1.50 credit, our average, I just remembered that okay. Sorry. So we have $1.50 average credit. So that's our average win is 150. This is ignoring commissions and slippage and all that. So it's just taking the win rate and the loss rate. So our win rate on MEIC is basically around 55%. Now that can vary depending on what you're doing, but I would do a back test to determine what is the win rate for the parameters I want to use and what is my average win. And then you can plug it in this model. And the expectancy, so that takes, we've got a 55% win rate. So multiply the two, you get 82.5. Same thing for the loss, 150 times 45% loss rate. Your loss is 67.5. You enter your stop multiple over here. So this takes your initial credit and multiplies it by the multiple to get to your loss. So there's some internal formulas in this spreadsheet. And I'm making this available on Groups.io as well. So you can plug in information in the blue cells, and then it gives you the expectancy. The expectancy is for every dollar you invest in this strategy, what is your return? And in this case, with these parameters, nothing else considered, it would be $1.22. Now, if you change those parameters, like let's say we go to $1.50 and we don't know what the win rate is. Let's say it bumps our win rate up because we're taking more loss before we actually stop out. So instead of 55, let's bump that up to 60. And I just entered that manually. I didn't back test that. And it bumps our expectancy down. For every dollar I invest in this trade, I get $1 back. So I make no money using a 150 stop multiple unless I increase my win rate. So then I look for ways, how can I increase my win rate? And so I did some back testing and got it up to, I was targeting the same expectancy that I had in that first slide. So if you got up to a win rate of 64.6, which is almost a 10% increase in win rate, you could use a 1.5x stop multiple and get stopped out a little less, but your drawdowns are, your loss every time you take a loss is 225 instead of 150.
So Tammy, what did you have to do to get the win rate that high? Because that's
we'll show that in the back tester in a few minutes. Yeah, I couldn't tell if that was coming from in here or on Zoom. Yeah, Jeff, we'll talk about it in a minute. And then so multiple of two, I looked at what win rate you'd have to get for that to be equally as profitable on a not a win rate of two, a stop multiple of two. And you'd have to have a 71% win rate to make a stop multiple of two be equally as profitable as the 1x stop. So it just shows you if you increase your stop, you got to increase your profitability to offset that greater loss. And same thing with, and let's see, I have this set up where we can go to taking a profit target. So let's say our stop multiple is 0.8. We're taking profits at 1.8. And, you know, we've got a 55% win rate with the standard, 0.55. So if our win rate stays the same, which it's going to change at 0.8, you could make more money using a profit target, but I would want to back test that to see what the actual win rate is, because your win rate is probably going to go down because your stop is closer to your trade. So let's say if it goes down to 50, you know, then you're getting close. So you could tolerate down to a 50% win rate. Now I actually trade like a 0.95 stop multiple. And so my win rate is about 53, 54, enter there. So I'm at 1.2. Let me type in 53% win rate, 1.19. So it's about the same. And let me go back to the presentation and we'll get into some back testing. How are we doing? About 10 o'clock. So, okay, we got a little more time. I'm going to go through this presentation, and then we're also going to get into some of the details of back testing and some of the details of the automated trading platforms. And I'm going to take a break though at a certain point after I go through this presentation before we do all that. So I don't want to have us sit here so maybe could be another 15 minutes. We'll take a break. Any questions? I'll break for questions. Any questions from Zoom or?
I have a question. Can I ask a question?
Sure.
So about the width of the spread, imagine, you know, are you using the width for the buying power only, or also to calculate the maximum loss? Because in case of a big account, wouldn't it make sense to say, I'm using a stop limit order, a stop market order to just buy cheap wings to just, to balance the maximum buying power that we're willing to risk, but still we trust on the stop?
You could do that. I just still always pay attention to your buying power and just stay within that rule of not risking more than 50% of your buying power. So yes, by using wide wings, you are going to increase your buying power, or cheap wings, like 5-cent wings in today's market. Man, that could be a huge spread.
Oh no, in today's market, I understand, but
Yeah,
theoretically,
normal.
since you have the stop market order, why stop at 50% of the buying power if you could calculate 80, 90% and still, be more efficient in terms of the credit that you get, or just go to a lower delta, if that makes any sense. I don't know.
If you want my recommendation, I would say you can do whatever you want. I'll put it that way. But you're putting yourself at great risk if you use, let's say, 5-cent wings and you use more than 50% of your buying power. Because, and this is the one thing I don't like about the option market, weird things can happen. And just every week I hear about something weird happening. And you could, it's not like your buying power is hardly ever at risk. It is always at risk. If you're in the market, it is at risk. Like something happens and we go to nuclear war, the market is going to go to, it's going to hit those circuit breakers and the option market's going to shut down and probably not open for several days. And you're going to be at max loss on your trades. So be aware that max loss is real. And so that's the reason I wouldn't just go crazy with using buying power and increase my risk. So unfortunately, I hear all the time from people who have blown up their accounts. And it's one of the things they do is email me, like, what can I do? And it's like, here's what I see, not much at this point. That what you could do was when you were determining your position size and with the spreads and things like that, it's in that decision making that you protect yourself.
And I think
Perfectly answered. Thank you.
Sure.
to reiterate your point, Tammy, is yesterday my account got locked out, which means I could not enter any orders to get out.
Yeah. Oh.
And it wasn't my mistake. It was actually the
broker's
broker's
issue.
So be aware that can happen to you.
Yeah.
I don't know where.
Yeah, just weird things can happen.
Yeah. I have a quick question.
Yes.
You said you do ladder into your iron condors.
I do
enter
leg
one
in,
side
yeah.
and enter another side.
Yeah.
So
In manual trading, yeah.
Right. So obviously, if the market is ripping up, you're doing a call credit spread. You're taking advantage of that up momentum in the market. That's what you enter first.
I would enter the put. If we're moving,
Sorry.
if we're moving up, I enter the puts first because those start gaining money as that's moving. And then in manual trading, I may wait to enter the calls until it kind of settles down.
Right.
Or if it doesn't settle down, I just keep the puts on. Most of the time I enter both sides at some point.
Exactly.
But,
Now,
yeah.
how is your performance doing? Trading fully manual versus trading automated? Is it worth the time you're putting in?
Yes, I tend to do slightly better in manual trading. The downside is, like, I can set the automated trading to trade when I can't trade manual trading. So I tend to trade more in automated trading. So I post my results every month online. If you look at those, you'll see, and I would call it up, but it'd just take too much time. But you'll see that my return to March is lower than in my automated trading, but it's simply because I have been trading less in manual trading than I have been in automated trading. So if I go skiing, I turn on the bots and I just go skiing and I don't trade. But I'm trying to do more of that this year, trying to take more personal time and not trade every day. So it doesn't feel like a job and I take some time off. But the automated trading, no, and I'm going to talk about that toward the end of the presentation, who does provide it and what brokers it's available on. You have your account at the broker, and it's kind of a plug-in on top of that. Yes, yeah, and it just goes to your broker and places the orders and things. So I'll talk through that. I was gonna do some back testing to test other multiples, but I'm gonna move on because I'm at slide 40 out of about 60, and I want to just keep it rolling. So I personally like to trade what I call MEIC plus, where I do this in manual trading. I can't necessarily control it in automated trading. I aim for similar credits on both sides so that if I am stopped out on one side, I am at break even. I don't lose money that day. And I can't control it in automated trading. It picks what I can control, a range of credit it looks for, but not the actual credit. So in automated trading, I'll end up with higher credits on one side than on the other. And I hate that. Sometimes it's enough that I can add another put, to get to, so I'm still risking the same amount. But when I set my stops, I set them for 10 cents less than a 1x net stop. So that if I'm stopped out on one side, I make a little if the other side wins. So I'm not at break even. I've actually won, it's basically $10 a trade that I make, or $10 a contract that I make by doing that. Also, by doing that, you can offset what slippage you may have, and we'll talk about slippage in a minute. But it's another strategy for dealing with slippage. And I set the stop on the short leg, my personal trading, because of some things we'll get into. I'm not going to go in depth now, but I have lately started setting the stop on the short leg. I multiply the total credit that I got for that side by 2, then I subtract 10 cents, and then I add the value of the long that I expect at stop out. Like I expect some decay, and I'll show you some examples. I expect some decay, so it kind of depends. If the market's just ripping around, I may put it at 1.2 times the long. If it's moving, kind of a slow market, I'll use 1.2, and I'll show you some examples. The reason I do the 10 cents less so that I make a little on break-even trades is this slide. This shows on the past 5 years, we've had 297 break-even days. If I can make money on those 279 days, instead of just breaking even, then I just increase my profitability overall. And there's in the 5 years, this is back-tested results, not live trading. I've showed in the past presentations my live trading results, and they're similar, but not this. I haven't tested this far back in personal trading. But 500, so it's roughly 54% of days are profitable. 19% are losing days, and this is the whole day, not trade. So this would be 6 trades placed a day. 20% of the days are losing days, and 26% of the days are break-even days. So if I can take those 26.3% days and get a little bit of profit on those days, my theory is it just makes me more profitable overall.
They're also getting stopped.
And maybe I'm setting my stop slightly less, so I'm getting stopped out a little bit more. And I tested that for this presentation, so I can show you. Using a shorter time period, the last 6 months, that curve is going to vary. So in the last 6 months, 46% of the days have been profitable. And this is through April 4th, so it doesn't include this week. 32% of the days are losing days, and 21% of the days are break-even days. So the shorter the time period, you're going to get more variation. But let's look at, let me go to back testing. So here's back testing, setting the stops at 100% of the initial credit. And so this is trading on option, this is back testing on option Omega, because I can't adjust down to a 0.9x stop on BYOB. So I can only do that on option Omega. So I tested this to get the win rates, and just look at the P&L. P&L is 17.9. The compounded annual growth rate is 39. Max drawdown is 2.8. So and the 56% win rate and a $1.35 lot is your average winner. So I'm going to use those to plug into that expectancy model. So with that, I get an expectancy of 1.28 using a 1x stop. No, ignoring slippage and commissions, that's going to take a bite out of this, but that's using 1x stop. Then using a 0.95x stop, the total P&L goes down 15.9. The car goes to 34.5. It goes down a little bit. Drawdown is also a little bit less. My win rate is 54.9. So I'm going to take that and plug it in there. And so using 95, 135 for my average win, the 94.5, the expectancy is exactly the same. Now, I think why this showed the 100% stop is a little more profitable is you got a few more stops using this one. You've got slippage and fees that are going to subtract from a few more stops in that back test. So this was 4 years. I think I did. No, I'm sorry. This was just 6 months. This was the past 6 months. I'm kind of all over the map with my back test. So, but this just looks at the last 6 months. So they're close. It could be looking at a longer time period. The 100% stop shows even better. So it's, I've been doing this for a while. It psychologically, it helps because I could stop out on one side on every trade and still make $400 or $500 a day and feel good about that trading day rather than stopping out one side and making nothing after all day of trading. So as long as I'm close, I'm happy. I'm probably still going to do this, but it just does show that it does impact the profitability a little bit and the return a little bit. So to be all above board. So the next few slides, let me see how many we have. Got a few until I get to here. Yeah. Okay. So the next few slides, I'm going to talk about lessons learned this year. And there have been a lot of them. With a large number of entries on a strategy like MEIC, the small fees, like fees, commissions, slippage, they can add up to a huge amount of money that just takes away from your profit. So with 6 entries a day and 250 trading days, that's 1,500 potential trades. And if you're losing $1 on every one of those trades, just slippage or fees, or whatever, it's a huge impact on profitability. So one way to improve profitability is to reduce your fees, go to a lower fee brokerage, reduce slippage as much as possible. And we've also learned a lot about slippage this year on how it works and why. And, it used to be like I almost never saw slippage at E-Trade. And I started trading at IBKR and every trade had, 15, 20 cents of slippage. And why? What's the difference in the way these two brokers are operating? Well, we learned why this year. And so it's where your stop orders are held. Different brokers have their own rules for where they hold stops. Some brokers hold the stops at the brokerage. Some brokers send all stops to the exchange. Some brokers give you a choice of whether you want us to hold your stops at the brokerage or send them to the exchange. Slippage is the difference between the price of your stop and where your trade actually closes. So if you have a stop for $3 and you get stopped out for $3.30, you've got 30 cents of slippage. That just comes out of your profits. And it's greater cost than that 1x stop. So it's 30 cents greater. And we also have learned CBOE does not accept complex orders to hold at the exchange. At least right now, they tell me that they are looking at being able to hold complex orders at the exchange, and that may solve this issue.
So what's a complex?
A complex order is a spread. So anything more than a single leg is a complex order. So it's not a complex like OCO and that kind of complex. It's just a single leg order versus a spread. So only single leg orders can be held at the CBOE. Now, if your broker doesn't send it to CBOE, they hold all orders at the brokerage. Even though you've done a single leg order, it's going to be held at the brokerage. All other orders, any order that is not single leg has to be held at the brokerage. So stop limit orders, stops on spreads, any other kind of complex order besides just a single order on the single leg are going to be held at the brokerage. And once it's triggered, they then send it to the exchange. So once a trade is triggered, if it's held at the brokerage, it's triggered and then they send it to the exchange. but it gets in line behind all those other orders that are sitting at the exchange. And that creates the potential for higher slippage. And that's why E-Trade was sending all orders, including spreads, to their market makers to hold. That's why I was seeing no slippage on my trades at E-Trade. The market makers basically this year, last year, balked and said, E-Trade, we only do this for you. We don't know why. We're going to stop doing this. So E-Trade stopped allowing stops on spreads so that they could send all orders to the exchange. So any order that is sent to the exchange is going to be executed faster than an order that is held at the brokerage and then sent to the exchange. They sometimes you won't get much slippage if there's lots of liquidity, and that's fine. But sometimes you will see huge slippage, 50 cents or $1 or more difference between a brokerage like IBKR that holds all orders at the brokerage and something like Tradier that sends all orders to the exchange. Yes, Peter.
So you only put a stop on your short legs.
Mm-hmm.
So is that considered one leg?
That is considered one leg.
So
and I manually close. In manual trading, I'll manually close my long leg. Or automated trading, they have a method for dealing with that where they will close it for you. If a leg gets the short leg gets stopped out, it will automatically close the long leg
so
for
you
you.
receive a benefit by putting a stop on the short leg, and it's held at CBOE.
Only if the broker doesn't hold it. Because some brokers, even if it's short leg, they hold all orders. And in my next slide, I'll just say, let me finish up this slide and we'll go on. But and I compare brokers and I give you all that of where orders are held. So to reduce slippage, the best thing you can do is use market orders and on single legs to be held at the exchange, and check with your broker. I checked with a bunch of brokers here. I know a lot of them. I've called a lot of them, but so fees is another big impact. And so here's all the brokers and the various fees they charge. So fees can also have a huge impact on your trading profitability. Even if you're trading the same strategy, just different fees will have a different impact. Any trade in SPX, and we're talking trading SPX here. So any trade on SPX is going to incur the fee, the CBOE fee, the exchange fee of 53 cents. That's what CBOE charges the brokers. Now, some brokers take that fee and just add it to their fees and charge their clients that fee plus the fee, and on top of their own fees. So here's the range of fees. Most of the brokers, there's probably some other brokers out there that I don't have on this list, but these are the common brokers that I hear about that people are using to trade options with. And like IBKR has the highest. Are you raising your hand or no? No, okay. They have some of the highest fees. If there's two fees listed, the first fee is the fee for options greater than $1 premium. The second fee is for options less than $1 premium. So like if you have one leg that you paid $1.50 for and the other leg, like the long leg costs you 45 cents, you use the lower fee for that 45 cents. And that's what it is most of the time on our spreads. If you trade 2 or more contracts at IBKR, they give you a discount, but still it's a pretty high fee. Tasty Trade gives us some of the highest fees. They charge $1 fee for their fee is for trading an option contract to enter is $1. They charge nothing to exit. So you've got the entry fee and the exit fee, which are different. But Tasty charges 75 cents for that CBOE fee. So they're making a 42% profit on the CBOE fee for every SPX trade you place. Yeah. And However, they just charge you the CBOE and the CBOE fee plus a transaction fee. Now, some of these other brokers charge 3 cent or 10 cent transaction fees too. So they're not the only one, but they're the only one that marks up the CBOE fee that much. And then Schwab, that's negotiable, and I think all of us pay different amounts at Schwab. So I just put kind of a middle range fee in there. You can use this to figure out your own fee. Tradier, if you use the Pro Plus package, it's 83 cents per contract, and that's 10 cents. You know, like Tasty Trade charges $1 per contract. Tradier charges 10 cents a contract and 10 cents to exit too. Which one is the more cost efficient, you think? And they charge 65 cents for their CBOE fee plus 13 cents transaction fees. So it totals up to 83 cents a year. Then you get that fee. They also charge you $35 a month to get that fee with their pro package. So you got to add that in there. And on our number of contracts for trading one contract, that averages out to about 10 cents a contract. So I add that in. You know, it's essentially 93-cent fee instead of 83-cent total fee. E-Trade is negotiable, but kind of the rack rate is 85 cents a contract. That includes the CBOE fee. And TradeStation is by far the least expensive one, 53 cents. They don't charge for options. They just charge the CBOE fee, pass-through cost.
That's only if you're trading through TAP.
Oh, okay, okay.
Yeah, that's what I was-
That's okay. What is it for outside TAP? Okay, so take that with a grain of salt. It was,
You ought to add to your slide.
yeah, in fact, I can do that now.
If you're using trade options.
Only fee, only for TAT. I'll put that in there. And I'll update this. I'll find out what they charge and
So how do they
update.
make their money? How does TradeStation make their money?
Don't know. Their business decision. Maybe off of margin. Maybe they're hoping you use margin. I don't know. So anyway, the impact of that, I did this chart to look at trading. These are all the brokerages and the various combinations, like one contract or two contracts. At Schwab, you have non-STD stops, which they hold at the brokerage, or STD stops, which they send on to the exchange. They don't allow stops on spreads on STD stops at Schwab. So you have to use a single leg stop for that. But the fees are the same, but where it's held is different. So this shows, I included a cost to enter one iron condor and the cost to stop out of one side. Since MEIC is basically a 50-50, 50% stop out rate, I thought that would give a pretty realistic number. It may be slightly off. So the total cost to stop out to trade one iron condor stopped out. The highest fee is at IBKR at $9.63 per contract to trade one contract of MEIC. The next highest fee is Tasty Trade. But if you trade more than one contract at Tasty Trade, IBKR, you get a fee reduction. So then Tasty Trade ends up being the higher fee. And then I just did all the math. So Schwab ends up being about $6 a contract per IC stopped out. The lowest fee was TradeStation based on that fee. So that's only for TAT. I'll have to amend this slide. But you can see if you trade 230 trading days, you don't trade the FOMC days and maybe the days that meeting minutes come out. I just rounded up to 230, but you do 6 entries a trade. That's how much those fees per contract are costing you each year. So that's a pretty big bite out of your profits. And you can still be profitable with those higher fees. I mean, I've traded at IBKR, but man, you start looking around for ways to save those pennies. Now, the other thing is slippage, and slippage actually has a higher impact. So high slippage, the highest average I've heard about, and there may be people with higher average slippage. When I was trading at IBKR over the past couple of years, it averaged 18 cents per stop out of slippage. So if the cost of trading one iron condor stopping out is $18. So that just comes out of, you know, how you were at break even. Well, now you subtract $18 from that. You're not at break even anymore. And you subtract the fee for that. So that high slippage is generally for stops held at the brokerage. So if your brokerage holds all orders at the brokerage, you know, you're going to end up, it may not be 18 cents. So I put some others in here. I don't, you know, it's keep track of it and see what it is, because it can total up to a huge number. The lowest slippage that I've seen is trading at Schwab, E-Trade, and Tradier. All of those are low slippage because all the stops are held at the exchange, and they're generally around 4 cents or 5 cents slippage on per stop out. So it'd be $5 on a stop out. So your total over 230 trading days and 6 entries a day on the high end could be $24,000, almost $25,000 you're paying out of your pocket, out of your profits for the slippage versus $7,000 on the low end. It is huge. Yeah, it is huge. So that's why I want to make people aware. This is all us experiencing this because of the high number of trades and kind of comparing, like, what are you getting for this? What's your average slippage? And, you know, this is the kind of stuff we share and talk a lot about in the Discord and the Facebook. Absolutely not. Yeah, absolutely not. So the other thing is we've had to learn how to set the stop on the short leg instead of setting the stop on the spread. And it's complicated. So, you know, if your eyes crossed a minute ago when I started talking about how I set the stop, I try to explain it all in detail here. You know, if your stop is on the spread and your spreads are being held at the brokerage, that's fine. You don't have to worry. You just set it for 2 times the initial credit. It's easy. You might want to subtract a little for slippage, compensate for slippage, but that's fine. But when you set it on the short leg, there's a couple of ways you can calculate it. You could set it just on the short leg for 2 times the short leg and hope you get out of your long leg at 2 times the value of your long leg. And that would be a 1x stop. But what happens is often, as long you're in the trade, the further out of the money options are decaying a little faster than your closer to the money short options. So you're probably not going to get a 2x, 2 times the value of what it cost you on that long. You're going to get a little bit less back. So that means your stop is actually increasing from a 2x stop to 2.1, 2.2x. You know, you'll have to figure that out. I don't have the data on that. But then another way to set the stop is you can estimate the value of the long leg when setting the stop. And that's what I do. For example, take the total initial credit you got for the trade, multiply that times 2. That's my stop of where I would get out at a spread. Then I add in the estimated value of the long, and I usually start out at around 1.5. These days, maybe we are getting stopped out at 2 times with the market moving as much as it is, but I usually estimate the value as 1.5, the original value of the long. And I show some examples if this is hard to understand.
Right.
Yes.
You are always been letting it expire, correct?
Yeah, I'll always, if I leave it on to expire unless it hits the stop.
So normally
the trade,
you're not
yeah.
paying to get out.
I'm still using a stop. So I don't not use a stop. I still use a stop, and the stop is still set for a 1x net loss. So
just
Per
setting
side.
up stop.
per side.
Side.
Yeah. So if I click,
Just setting a stop, it's costing you even though you're letting it expire.
No, it doesn't cost a thing to set a stop.
Right.
Yeah. This is how I figure out what the stop is going to be set
Right.
at.
You're letting it expire, so it's not costing you anything.
If the trade expires, it doesn't cost a thing and I make the money. Yeah. This is setting the stop because I want that protection. I don't want it to go thousands of dollars in the money and I lose that. So I do somewhere between 1.5 value of the long and the original value of the long, like a 1x of the long. So that's like if I this is, I'll show you in a slide, it'll explain it better. But on either of these, you can adjust the stop if you choose as the value of the long decays throughout the day. So to more accurately stop out at a 1x stop. It does require, if you're trading automatic trading, it requires getting in there and tinkering with it. That's easier said than done on some platforms. Manual trading, it's pretty easy. But, you know, if you're trading multiple accounts, like some of us here I know are trading, you know, 5 or 8 accounts, it just becomes impossible. So you try to use one of these techniques to get you as close as possible to what you want to happen. You get to choose. And so the stops, again, to reiterate, the stops on the short leg may or may not be held at the exchange. It depends on your broker. So even though you're setting stops on the short, it's only those brokers that go ahead and send it on to the broker. And I do want to point out one thing. Yeah, I did. I learned yesterday, I had this slide all set up. I learned yesterday, I called Tasty Trade and asked whoever answered the phone, do you hold stops at the brokerage or do you send them to the exchange? And they said, we hold them at the brokerage. And I said, is that all stops on spreads or stops on the short leg? If I put a stop on the short leg, that would still get held at the brokerage? They said, yes. Well, somebody knows Scott Sheraton at Tasty Trade, and after I told them that on Discord, they called Scott Sheraton and said, do you know your guys are saying that you hold all stops at the brokerage? So I'm going to call them Monday and see what they say, because by Monday they are going to have a different story. They tell me that stops on the short leg, Scott Sheraton believes that those are sent on to the exchange. So validate that. I don't know, for those of you who trade at Tasty Trade. So that's going to impact slippage. It's not going to impact your fees. But anyway, I just remembered that. So of the various ways you can set stops on the short leg, like you can't just use 2 times, or you could, but you're gonna take a larger loss than you expect. Here's the stop on this. Here's the basic stop. Stop on the spread. The short leg is, we sold it for $2. We bought the long leg for $4. So we got $1.60 credit. So we set the stop for 2x, for 2 times the initial credit. So our stop is set at 320. The net loss is 320 less our initial credit, or 160. So it's basically 1x loss. Example 2, setting the stop on the short leg at 2 times the initial credit of the short leg. Let's just do that. So it stops out at 2 times. That's easy enough to calculate. So our short leg is $2. Our long leg is 40 cents. Our net credit, it's all the same. But this time we're going to set the stop for 2 times the initial credit on the short leg. 2 times $2 is $4. And then we'll close the long leg manually when we get stopped out. So I just estimated, let's say that 40 cents goes up to 60 cents by the time you get stopped out. It's moving toward your long, so it's going to increase in value. You're going to get some value out of it. So the cost to close is the $4 that cost you to get out of that short leg, plus the 60 cents you were able to sell the long leg for. So your stop is actually at 340 instead of 320. So that's a little greater than the 2x stop. And so the net loss is a little more than a 1x loss. but it's easy to do and easy to calculate. So I tried to do this. It's a little more complicated, but it gets me closer to a 1x stop. And I did a look at the last year since I've been trading stops on the short and how close it got to a 1x stop. It was pretty close. I mean, I was within 5-cent slippage, which is the normal slippage for a stop. So this works pretty well to get you out at a 1x stop. So the stop on the short leg, we're going to set it at 2 times the total initial credit plus the estimated value of the long leg. You could also do it vice versa. You could 2 times the total of the short leg minus the cost of the long leg. But it's easier for me to do it this way, to look at my total initial credit. So my total initial credit is still $1.60. I set the stop for 2 times the total initial credit plus some value of the long leg. So in this case, 2 times the total initial credit is $3.20 plus, and I'm going to estimate by the time I stop out, that long leg might be worth 40 cents. I mean, might be worth 60 cents. So add 60 and my stop is so I set the stop for $3.80 instead of $3.20 or $4 like in the prior example. And then I close the long leg manually, and this is where estimating the stop, I've gotten better at it as I've traded it. It depends on the time of the day, like how long I'm in the trade. Like I'll set it for, I'll do this and use this to kind of cover that minus 10 cents cost that I usually throw in for the MEIC plus. But so the close long leg manually, it cost me 60 cents to close. It could be 40 cents by the time I exit out. So the cost to close becomes $3.80 minus 60 or 40 or whatever that long leg is costing at the time, or I sell it for that. So I collect 60 cents for that. So my net stop is $3.20, which is the same as where it would have been at a 2x times the initial credit. So, and this is without considering any slippage. So if this is confusing, study this slide and work on it a while. I think some of y'all have caught on and are doing this, but it's a little complicated. But I found that doing this, it kind of builds in that slight reduction in the stop that I was doing, like by putting a stop at 95x instead of 1x. And so something to consider. Now we're going to take a break. It's almost 11. We've been going for about 2 hours. Excuse me. We'll take a short break, and then I'm gonna pause the recording for the Zoom people. And then are there any questions before we take a 10-minute break? And I'm going to go over back testing, and then I'm going to get into the automated platforms a little bit too. And I can stay as long as we want today. So whatever questions you have, or if you want to see something, we can look into it. Any questions online or? Okay, so a 10-minute break.
Tammy?
Yes.
Sorry. Are you able to do example 3 using TAT?
Yes.
So how do you set it up in TAT?
In TAT, I go look at what my long cost me. I have TAT set up a stop, and then I go check that stop and adjust it if I need to.
Okay, so you adjust it after it's entered.
Yeah.
Okay.
But I have it set pretty close to where it is. I'll show you that setting.
Okay. Thank you.
How I have that set up. Yeah. So I do this. I have this set up in both Trade Steward and in TAT. Trade Steward, I can't adjust the stops on the fly like I can in TAT, but TAT, yes. So we'll talk about that 10-minute break, and if I can figure out. I hope I've been recording all this time. Oh no, that was the PowerPoint record. Stop. X. Yeah, I see this record thing button. That fools me every time. Where do I pause? There, pause the recording. Okay. Go back to it. So next, I'm going to talk about the two main back testers that most of us use. There used to be back testers out there, but they were only using end of day data to back test. So yeah, sorry to interrupt conversations. But there used to be a lot of back testers out there, but they were only end of day data, which does no good for zero DTE or any shorter term options trading. You've got to see what's happening intraday. So the two back testers that I think are the best for MEIC is, first of all, the Trade Automation Toolbox has what they call BYOB, and it was designed to test MEIC, and it is free to use. So you can just go to the site, and it comes up, and so you can fill in various parameters. And another back tester is Option Omega. Option Omega is a more full-featured back tester, and you can test MEIC with it, but it has some limitations, like in how you separate the legs and some things like that. So, but there is a charge for that. It's either $100 a month or $600 annual, but you can get a 50% discount off of either of those if you use this link, just www.optionomega.com, register Tammy Chambless, and that'll get you 50% off. And that's a permanent 50% off discount, not just this year. Like for as long as you're using it, you're getting 50% off. So it's a great deal. You know, if you take the annual subscription at $300 and you're getting that, or you're getting an annual subscription at $300, it's like, you know, $50 a month or less. So $50 a month. Is that right? Whatever. I can't do math when I'm talking. So here is BYOB and just what the basic layout looks like. And so I will say, anytime I give a presentation, almost immediately it's out of date. And this one is out of date. Because I talk about how, let me go back to that screen. One of the things I talk about in the instructions is there's different data sets here, and he posts different data sets from time to time. Well, there used to be one without the open slippage automatically added in. Well, he's taken that out now for some reason. I'm going to ask him why. And he's always including 5-cent open slippage. So if you're including open slippage there, don't put slippage in the open down here. Just leave that blank. But I usually use target premium max, because if you use min, it could be using credit targets up to, you know, 8 or 10 or whatever dollars. I don't want to get it at that high a price. So I use the max credit target. I usually, you know, around $1.80 maximum premium gets me an average credit size in the range that I want, around $1.50. And then you can select from a variety of spread widths, you know, exactly 25 wide or a range of 20, 25, 30. These take a little longer to run, but they work fine. Then number of contracts, you know, you either run a fixed number of contracts, but it's not going to include compounding. And compounding is definitely what did Warren Buffett say, the 8th wonder of the world. And so it's better to use percent of buying power, and that is for each trade. So percent of buying power, if you're entering 6 times and use 8% of your buying power times 6, that would be 48%. So you'd be using 48% of your total buying power over all the trades. And here's where you could set up, you know, like a maximum quantity of, like, don't enter more than 50 contracts in SPX, you know, if you get to that point. And starting balance, I'm just going to put 100. Expiration, there used to be a profit target in here. He's taken that out. There are various stop losses you can check. Some are only based on certain data. You know, you have to test within the 2023 time period for that. I just avoid those. But since I use a 1x stop with my testing, that's what I put there. Open commissions, this is per spread. So it's, you know, like if you're trading for, you know, like trade year at 83 cents a contract, this has to be per spread. So for me, trade year, I use 165. I just round it up. And then that closing slippage, I usually put in 5 cents. If you're at a different broker and you want to put in, you know, 15 cents and see the impact of that, you can do that. And then test period, I'm gonna test a short period just because it doesn't take as long, 2024. And I'm gonna leave the end date blank. If you leave the end date blank, it just goes to the latest date it has in its data set. Same thing on this Monday, Tuesday, Wednesday, Thursday. If you don't click any of those, it uses all of them. If you click 1 or 2, it uses those. Or if you click all of them, it uses all of them. But if you don't click anything, it uses all of them. I exclude FOMC days, and then I enter my trading time. So I'm just gonna enter one. Here, let's just do a couple here. That would be entering too early. Let's just do 3 time periods. And then you run the test, and the little working sign comes up here. And when that goes away, it's done. And then you can look down and see the results. And so you can test. Let's just compare slippage on those 3 entries. We had a 49% return. Let's increase slippage to 15 cents. And let's use the tasty trade. What was that? 7? Yeah, 1.78 plus, that's for the long one. Yeah, 1.78. Okay. Yeah, 1.78 and 0.78 to close, and high slippage. So we'll just see what that does. So brings it down to 23% return. So you can play with all sorts of variables pretty quickly here. I don't usually limit the VIX, filter by VIX or filter by premium. I would do that if I was using the minimum and then I wanted to not get an $8 premium or something. I'd say keep the premium between such and such. But anyway, so that's BYOB, very easy to use. I keep that, you know, a quick shortcut of that on my desktop. And
so why do they do it for free?
Because the guy that wrote this also wrote Trade Automation Toolbox, TAT. And that is his automated platform. He did it as a way to encourage people to trade MEIC and use his platform. So it's just a leader for his benefit. He used to do a bunch of back testing for us for Palm when we were in it, and he set this up for us and to show us how well this worked. So anyway, that's kind of the results it gives you. You know, it tells you your average win percentage. You know, the things that I look at when I'm testing is kind of what that average win was. For that setup, we got $1.25 and Calmar. Sometimes I'll look at what the biggest losing day was, how many days to recover, 23 days to recover from that loss. You know, I'm always looking for long or low drawdowns, so that max drawdown is important to me. So a detailed description on how to use BYOB, I'm going to make available. I put this together last year and I updated it for this presentation, but I say, you know, use this tick pricing without the slippage. So now this is a little bit out of date. I'll correct that before I post this afternoon and get that up to date. Or I'll check with Kyle and see if that's an error, if he meant to leave that counting the slippage?
It costed twice the data.
Oh, okay, to
On
do
the
both,
server to do
yeah.
both, yeah.
So he had to pick one,
Yeah.
okay. So anyway, this paper, it's about 10 pages long. It goes through every option and tells you how to use that. And, you know, what the features are and what's available. So, now the other platform to use is Option Omega. And it's a little more complicated to use, but it's a lot more flexible. Like I can test a 0.9x stop instead of a 1x stop, which I can't do. On BYOB, I can only use that drawdown menu of what options are available. But with Option Omega, I can do a lot more with that. And I'm going to go to that. And I may put some of these tests like this already set up. I'll put the link on the group's IO, so you can click on these for MEIC. But unless you have a subscription, you can't open these. So you have to have a subscription or be a paid member of Option Omega, and then you can click on the link and the test will come up. So the way it works is it has all these features. You enter a start date and an end date. You enter a strategy, and it will preset up some of this for you, and then you can adjust it as needed. And you can enter put side and call side, and kind of the same thing. Starting funds 100,000, allocation of buying power per trade 8%. Set up the entry times. You can just add, or I'll just take out a few entry times here, and yeah, or add entry times and do whatever you want there. Then you can enter how often you want to trade this. So this is set up to be able to test longer dated strategies as well as zero DTE strategies. The BYOB is just zero DTE. That's the only data set it has. So you just test that. Now here you could test it with different VIX levels, different indicators, you know, and see if you can find something that works better. You can use intraday movement somewhere in here. I don't remember where technical indicators. That's where you enter. If you're testing METF, the multiple entry trend following, you can use technical indicators and enter your moving average. You know, the 20. You know, enter the puts if it's below, or the enter calls if it's below the EMA, and enter puts if it's above EMA, all that kind of thing. I'm going to turn that off. And then you can group your legs so that you can set stops on individual legs. So here's where I set, you know, a 90% stop, and I'm using intra-minute stop. So it's checking within that minute. Most of these backtesters use 1 minute data from CBOE, but it checks within that minute the open, high, low, close to see would it have hit a stop within that minute. And then it goes and grabs the data for that. So there's a stop on the call, a stop on the puts, and then I add fees and commissions here. And here you just do it by leg. So like for the, not by the spread. So for just for opening and for closing contracts, you can enter for legs. So it will figure out I've got 2 legs, I need to double that. And that's why I think that fee we said was wrong, because that was for one spread at Tasty. Is it $1? Okay. Not $1 plus $1 for 2 legs. Okay. And then I also set cap non-opening losses at the stop loss. If you don't set that, it will just use whatever whatever at the end of the 1 minute period where the price for SPX is at the time, and figure out your stop on non-opening losses. So you want it to cap it at the stop loss when you're testing it. So then you come down here and hit run, and it will, I'll go ahead and do that, and you can see, I think we only had about three or four entry times, sorry. How many people do we have online now? Did we lose a bunch, or they stick with us? Okay, still high. Yeah, so it's fairly quick with that run with those entry times, and it gives you a summary of what your setup was up here. So if someone sends you a picture of this, you can kind of go set this up yourself, or what their trade is. And it's an easy way to run a bunch of back tests and see, nice equity curve. Love that equity curve. So those are the back testers that we use. And Option Omega, they have, let's see, they have a lot of videos on how to use them. There's some written documentation, but they have another group at
11:30.
At 11:30?
5 minutes.
Oh, they told us when we set up the meeting that we had it till what, 1 or so?
That is next month.
Oh. Okay, well, we gotta shut down. Sorry, guys, on the Zoom. What I'll do is I'll make a Zoom call. I'll do a recording of this and just record it and tack it on to this presentation. We're losing the room here, so I'm gonna shut this down. Thank you all for attending. Sorry, we got cut short. And if I'd known that, and I will go into the automated platforms in that Zoom that I tack on, or the recording that I tack on. So, sorry, we have to cut it short. Stop.